Everyone, and thank you for joining us. I hope you're all doing well during these kind of challenging times here. As Emily mentioned, I'm a senior manager in our assurance department. I've been with Wegner for a little over 11 years now, and I work with both not-for-profit organizations and closely held businesses. Throughout the presentation, as Emily said, there are going to be poll questions. There will be 5 of them in total. So kind of the goal for today's webinar is going to be to identify key changes and developments in the audit, accounting guidance, and regulations that affect the nonprofit industry. So we're going to be covering kind of what impact has COVID-19 had on financial statements and your organization, a review of recently adopted accounting standard updates or ASUs, new standards that are going to be applicable for your calendar year end 2020, new standards applicable beyond 2020, a compliance update, and then kind of just a general not-for-profit industry update. So you'll probably see COVID-19 mentioned throughout the presentation here. I'm sure we're all sick of it, but unfortunately it's had a major impact on the world and all of our organizations. So kind of some not-for-profit financial reporting questions and challenges. What kind of impact is this going to have on our presentation in our financial statements? What type of information should we be disclosing in our footnotes? We received COVID relief grant money. Is that conditional? When can I recognize it? And then I suspect a lot of you have received a PPP loan, and what does that mean for our accounting records and financial statement presentation and the related disclosures? So considering the financial statement impact, some footnote disclosures that might be applicable to your organization is going to be, has COVID-19 had a significant operating impact on your organization? Were you required to close depending on state regulations? Are there services you had canceled, activities that moved to online? With organizations that I've worked with this year that held conferences historically, a lot of them either canceled or transitioned them to an online function, and that activity was generally disclosed in the financial statements for kind of our calendar year and fiscal year end clients. We should also be thinking about disclosing the receipt of COVID relief funding. Has COVID significantly impacted our operations where we might have going concern considerations and disclosures surrounding that? Have there been significant changes to our operations? And then again, PPP loan details. So kind of put yourself in the shoes of the users of the financial statements. What are they going to want to know when they look at your financial statements? I suspect that the liquidity and availability of financial assets disclosure is probably going to have some heightened interest to your donors and other foundations and granting organizations. And then finally, are there going to be debt covenant concerns where you might be in violation of one of those covenants where you're going to need to seek out a waiver or have some sort of conversation with your bank? So COVID relief funds and revenue recognition surrounding them. In most cases, the funds that you receive through these programs are going to be conditional contributions due to the existence of a barrier and right of return. For example, if your organization received a PPP loan, is that going to be recognized when it's forgiven or when your conditions are met? It's going to be dependent on which accounting method you select, and we'll be talking about that in a future slide. Now, in addition to PPP, the CARES Act outlined several other relief programs. Some of them are listed here, but you're going to need to consider the specific details of each program and whether the timing of revenue recognition changes. And then finally, with these relief funds and the CARES Act, don't forget about the impact to the CFA. we'll be going over this a little bit later in our compliance section. Now, the accounting for a PPP loan. The AICPA issued a technical question and answer to this specific topic and allows for not-for-profit organizations to select one of the following models. So the first is the debt model, which is your typical loan accounting. And then the second is going to be your government grant model, which follows conditional contribution accounting. And your accounting for it is going to be dependent on what your intention is surrounding the PPP loan. You know, if you're intending to repay it and not have it forgiven, you should follow the debt model. And then you should be also accruing interest. If your intention is to have the loan forgiven or even partially forgiven, you should consider following the government grant model. And then just kind of as a higher level topic, you know, double dipping is not permitted. So what that means is you cannot use the same expenses to get reimbursed from a government agency under one of your grants and also apply those same expenses to have your PPP loan forgiven. You know, to maybe help with your, you know, differentiation in your accounting software to not have double dipping, we'd probably recommend that you set up, you know, if you're using QuickBooks, maybe a separate class for the PPP loan so you're not unintentionally double dipping. So if your organization is going to follow the debt model, you're going to initially record that loan as a liability. And then you're going to record accrued interest at the stated loan rate. And you're going to continue to record the interest as a liability until either the loan is forgiven or you've paid it off. Once that occurs, if the loan is forgiven, you'd reduce the liability and then record a gain. And then again, just kind of be aware of, you know, if you're going to be following the debt model, this could have an impact on your loan covenants. For example, your debt to equity ratio, because the PPP loan is going to increase your debt and it could skew the ratio in the wrong direction. Now, if you're following the government grant model, this is the one where you expect to apply and receive forgiveness. You initially record the cash as a liability, you know, for example, a refundable advance. And then after that, you're going to reduce the liability and recognize a contribution over the period in which your expenses are incurred, you know, similar to other government grants. And then when you're showing it on your income statement, we recommend it be shown, you know, separately. For example, PPP loan forgiveness, just to kind of highlight it to the users of the financial statements. And then the government grant model may only be used if it's probable that the loan forgiveness will be met. And then if for some reason in a subsequent year the loan is not forgiven, it's just going to be treated as a change in estimate in that year. And then this will bring us to our first poll question is, you know, how are you accounting for your organization's PPP loan? Are you using the debt model, the government grant model, unsure right now, or it's not applicable because you didn't receive one? And we'll give this about a minute or so.
People are answering, Tim, we did have one question. What about government revenue that is based on units hourly rate rather than based on expense reimbursement?
Yeah, that's a good question. Unfortunately, I have not seen any guidance that is specific to those units of service contracts. That might be a question for the funding source. But at this point in time, I don't have an answer one way or the other. All right, so we have the poll results here, and it looks like a mixture of things. You know, 23% for the debt model, 32% for the government grant model, 11% aren't sure, and then 34% are just not applicable. So we got a wide variety here. All right, financial statement disclosures related to the PPP loan. All organizations should obviously adequately disclose their accounting policy and the related impact to their financial statements. So disclosing which model you're following. Are you using the debt model or the government grant model? And then one additional disclosure is going to be related to, with the PPP loan, the SBA has up to 6 years to audit the forgiveness application. So what's going to happen presumably for the next 6 years is there's going to be some footnote disclosure surrounding the SBA's ability to audit it for the next 6 years, just as it's a potential loss contingency. Due to the fact that if they choose to audit it, the SBA may come back and say that some of your expenses that you used are not applicable and you're going to need to repay that. All right, so a review of recent major accounting standards. The last couple of years have had some significant accounting standards. We'll go over them just briefly. Typically in any given year, the FASB will release between 10 and 20 standards. The majority of those accounting standard updates are more so clarifying things, not necessarily major overhauls like we've seen the last 2 years here. So the first standard was from 2018. So it's the presentation of financial statements. That had a kind of a significant change on our not-for-profit reporting. It moved from 3 classes of net assets to 2 classes and also relabeled them to with donor restrictions and without donor restrictions, rather than the unrestricted, temporarily restricted, and permanently restricted. And then it also added the additional footnote regarding liquidity and availability of financial assets to meet your entity's cash needs within 1 year. For those of you with endowments, it also added information should those be underwater. So now that we're kind of entering year 3 of the standard, it's kind of like old hat, but in the time of implementation, it was a major change. And then this past year, so 2019, we had kind of 2 standards that were pretty significant. The first being 2014-09, which was contracts with customers, and then the other one being 2018-08, which was contributions made and received. These 2 standards were issued to provide clarity regarding exchange and contribution transactions due to differences in practice amongst organizations and CPA firms. So for our exchange transactions, it better defined those, and that there needs to be kind of a reciprocal transfer, or each party is receiving equal value. So for instance, membership dues. If you're a trade association, you have members, they pay you their monthly or annual dues, and in return for those dues, they're receiving some sort of benefit, whether it be educational or something else. And with the exchange transaction model, there was some clarification on, or there was the issuance of the 5 steps to determine when you recognize revenue. And then for contributions, this standard was applicable for resource recipients, and it better defined a contribution as an unconditional transfer of cash or other asset to an entity by another entity. So in essence, you think of your general donors, they're giving you a donation and they're not expecting anything in return. However, what it also did was better define a conditional contribution, and we'll see that on the next slide here. So a conditional contribution is going to have some sort of hurdle attached to it. The ASU created this existence of a barrier and a right of return as kind of those 2 hurdles. So indications of a barrier that could be an organization must achieve a measurable or performance-related outcome. So for example, that could be requiring a certain level of service or providing a certain number of units. You know, you must serve 10,000 meals in order to recognize this revenue, in order to get this money. It could also be a matching grant for a promise to give. It could also be incurring qualifying expenses. But there has to be some sort of, for a conditional contribution, there has to be both a barrier and the right of return. So the right of return is if you don't use the funds in accordance with the agreement, then you have to repay the donor those monies. And what this did was it better defined government grants as contributions. Most oftentimes, I believe we saw government grants kind of thought as exchange transactions. This standard moved them to the conditional contribution model. And then on this slide is it just shows some indicators of when a transaction is a exchange transaction and when it is a contribution. So what is the intention? What is the method of delivery? How do you determine the amount? Are there any penalties for non-performance? And then what is the not-for-profit providing in return? The ASU also provided a flow chart to assist with the implementation. So when you're thinking about your organization's transactions, you know, are both parties getting equal value in return? If the answer is yes, we're going to walk over to exchange transaction guidance. If the answer is no, then it's a non-reciprocal transaction, and we're going to apply contribution guidance. Then after that, it asks, are there conditions present? So is there that barrier and right of return? If there are both, then it's going to be a conditional contribution, and we're going to recognize revenue when the condition is met. If there is not both a right of return and a barrier, then we walk over to the next question, and it's going to be, are there restrictions present? So is there some sort of limitation, purpose, or timing? If it's no, then it's unconditional. If it's yes, then you're going to have with donor restrictions. And then also in June 2020 here, the FASB kind of as a result of COVID issued this ASU to delay some of the standards. Now, depending on your organization's fiscal year and your timing of your audit, this may not really have impacted you, but for a lot of our fiscal year clients, I know it did. So what the standard allowed was to push off the revenue from contracts with customers 1 year if you had not issued your financial statements yet. And then it also pushed off the lease accounting standard for another year. Previously, it was effective for 2021. Now it's going to be effective for 2022 calendar year. And then with that, we'll have our poll question number 2 here. So with that ASU that came out in June 2020, did you defer the adoption of your contracts with customers or your exchange transactions? So A, yes, we did. No, we adopted the standard, or C, that ASU was not applicable to us.
Just a couple more seconds to get your votes in.
All right, so the majority, the ASU was not applicable. there were 11% that said, yes, we did defer, and then 24% said no, and 65% said not applicable. All right. So what's going to be effective for our kind of December 2020 year end? For those of you that did elect the deferral, ASU 2014-09 is going to be effective for you. And then below this on the slide, we have the 5 steps here. We're not going to go into them in detail. If you do need some assistance, we are happy to provide that. Just reach out to your Wegner contact. And then ASU 2018-08, this standard, which we just previously talked about, was applicable for 2019 for resource recipients. For 2020, it's going to be applicable for resource providers. So those organizations that are granting agencies, now this standard is applicable for you. So grantors must apply the criteria to determine the appropriate timing of expense recognition. So if your grant has conditions as defined in the standard, you're going to need to recognize expense as those conditions are satisfied, regardless of when you give the grant money. So what we would recommend is that you review the terms of your grant agreements to ensure that the language within them reflects your actual intentions, and then modify them as necessary. ASU 2019-03, this was updating the definition of collections. The ASU specifically addresses the use of proceeds from sales and disclosures. So collections include groupings of art, historical treasures, similar assets that are held for the public, preserved and protected, and then when sold, the proceeds are reserved for specific uses. Previous to this standard update, the proceeds from sales of collections were only to be used for the acquisition of additional collections. The update allows for those proceeds to be used for the direct care of existing items already in possession, in addition to acquiring new collection items. You'll also need to, if you do have collections, disclose your accounting policy regarding how you use funds from selling items. ASU 2018-13 is an update to the fair value measurement disclosures. It's going to have changes to level 3 investment disclosures, and then also to transfers between level 1 and level 2. So what it did was it removed the requirement to disclose transfers between those 1 and 2 assets. And then it also removed disclosures related to the valuation process for level 3 measurements. And then in lieu of a roll forward for level 3, so that, beginning balance, additions, withdrawals, investment earnings, it removed that, but it left in there the requirement to disclose transfers in and out of level 3 and any purchases or issuance of level 3 assets or liabilities. And then ASU 2016-02 leases. So for the overwhelming majority, probably most of you, this standard is going to be applicable for 2022. However, for those organizations that are going to be considered public not-for-profits, this standard is applicable for 2020. An example is, let's say the not-for-profit asks a city to issue revenue bonds to fund a portion of a capital project or major expansion, and the not-for-profit is obligated to repay the debt to the state or local government. that's going to be kind of a conduit debt, and you would be considered a public not-for-profit, in which you will need to adopt the leases standard this year. All right, so that's kind of what is new for 2020. Not a lot of significant things, which is nice. And then the upcoming slides are going to discuss what's going to be new for beyond 2020. So again, good news, there's not much for 2021. The following slides are going to be ASUs that are going to be effective for calendar year 2022.
Quick question before we move on, Tim. Somebody asked, does application of 2018-08 for grantors change depending on cash or accrual basis of accounting?
I guess it kind of depends on, what the organization's method of accounting is. If they're cash basis, then I would say the standard's not going to be really applicable for you because you're using a other basis of accounting. If you're accrual basis, then the standard is going to be applicable for you. If we're talking about whether the grantee is cash or accrual, it doesn't really matter. It's kind of what you are doing as a grantor and what your grant agreements with those grantees state within them.
Perfect, thanks.
All right. So 2020-07, presentation and disclosure for contributed non-financial assets. So this is going to be your gifts in kind. The standard came out in October, I believe, of 2020. It's going to be applicable for calendar year 2022. It does not change how you recognize and measure gifts in kind. What it does is add additional disclosures to increase transparency around those gifts in kind. So it requires you to show it as a separate line in your statement of activities. I think a lot of clients that I work with already do that, but it just explicitly states it there that it cannot be included within contributions. It needs to be split out. It also is going to require the disclosure of what types of contributed non-financial assets you received during the year by category and how they were used. So the term non-financial asset, that includes fixed assets. It's going to include materials, supplies, certain services, things of that nature. And then it also requires a policy about monetizing rather than utilizing. So kind of an example is if you receive a donated stock and sell it right away. So you're monetizing that rather than using it in a program. The key thing here is that retrospective application is required. So while this standard is applicable for your calendar 2022, you're going to want to track this information for calendar year 2021, because when we get to the 2022 year-end audit, we're going to be requesting the 2021 information to disclose in the financial statements with it as well. So while you have a little bit of time here to apply the standard, you still need to be aware of what information is going to be required for 2021 information. And then again, ASU 2016-02 leases. So this is again effective for 2022 calendar year, and it's gonna affect any. This is I guess the largest or the most significant standard that is kind of on these slides yet to be implemented. So it's going to affect any entity that enters into some sort of lease or sublease. The FASB's goal of this standard was to address the off-balance sheet financing with operating leases. And so what it's going to do is it's going to bring these leases onto your statement of financial position as an asset and a liability. And so what you're going to do is recognize in the statement of financial position a liability to make lease payments and a right of use asset representing your right to use that asset for the lease term. And then the recognition, measurement, and presentation of expenses and cash flows arising from the lease is going to depend on how it's classified as either a finance lease or an operating lease. And then within the update, it's going to require qualitative and quantitative disclosures to help the users better understand what kind of leases you're entering into. So previously, GAAP had two types of leases. They called them capital leases or operating leases. Capital leases are going to now be considered finance leases, and you'll see kind of the criteria here are very similar to that of a capital lease. So you're going to have a finance lease if ownership transfers at the end of the period. The option to purchase the leased asset is reasonably certain to be exercised. The lease term is a major part of the life of the asset, or the present value of the lease payments is essentially greater than or equal to the fair value of that asset. Or the asset is so specialized that it has no alternative use at the end of the term. And if you don't meet either of kind of these requirements here, then you're going to have an operating lease. Still though, whether it's an operating lease or finance lease, it does require entries made to your assets and liabilities on your statement of financial position. And then on this slide, we have kind of the comparison of old GAAP to new GAAP. So like I said, we had capital leases and operating leases. So capital leases went on your statement of financial position. Operating leases did not historically. Under new GAAP, you're going to have finance lease and operating lease. And as you can see from the table, they both end up on your statement of financial position. And then within your statement of activities or your income statement, you'll see the impact there. And then also on your statement of cash flows. And then with that, we're to poll question number 3. So what is your level of readiness for implementing the lease standard? A, we've already adopted. B, we're getting ready. C, we're almost there. We just need to finish up or learn more. And D, we're not even close to being ready.
And while people are answering that, Tim, a question for you. In regards to the 2020-07, can you opt not to record or include as revenue?
2020-07.
It was one of the first slides you talked about in this section, and I think it's in regards to the 2021.
Oh yeah, so that's the gifts in kind standard. You know, it didn't change, the standard didn't change how you recognized revenue. So if you received things that, you know, for example, volunteer services, you know, those are not recorded in your statement of activities. So the standard for those types of activities are not going to impact you. It's going to be those organizations that do receive gifts in kind that that they've historically recorded income and expenses for. Those are going to be the ones that are impacted.
Perfect, thanks. And there's the poll result.
All right, poll results. So what is your level of readiness? We have some people that are already adopted, 5%, 24% says we're ready. About half of you said we're getting there, and then a quarter said not ready. So that's kind of about what I was expecting. You know, this standard is, like I said, it's the next major standard that has significant changes. And, you know, looking at my clients, I know some are ready, but then, you know, others that have a lot of different leases, I know they're not ready and they're getting there. All right, so our compliance update or our single audit. So what's changed for this year? Every year the compliance supplement gets regular updates. This year is not any different. And last year they issued the compliance supplement with a 6 requirement mandate. That mandate is still been maintained. Some agencies have modified it. There is a removal of Part 3-1, so that was previously included during the transition to uniform guidance. And for those federal awards that were dated prior to December 2014, those awards have all kind of run off now and they're not applicable, which is why they removed it. Part 5 relates to cluster lists. The list that was published is not expected to change. I guess a couple notes on that, what did change was there's a new cluster for a Head Start program. And then it also deleted a cluster for the Temporary Assistance for Needy Families, TANF. The requirements or compliance requirements for those programs are still there. They just, one became a cluster and one is no longer a cluster. And then Appendix 7 included a new section on COVID-19 implications. So the 6 requirement mandate, just kind of an update on this. The OMB issued a limit of 6 last year with some exceptions. So the R&D cluster can have 7 and then some agencies can have less than 6. Your allowable activities and allowable costs are counted as one requirement. Agencies, so think of the DHHS, they may have changed the requirements since 2019, so you just got to be aware of that. And then the 6 requirement mandate does not apply to those programs that are not included in the supplement. So your auditor is going to continue to use Part 7 to identify which requirements are direct and material, and that could result in more than 6 being tested. The most significant change, though, was the COVID-19 funding. So there were at least 20 new programs created. The CARES Act provided many existing programs with additional funding. Some existing federal programs have been granted flexibilities or waivers of compliance requirements, specifically student financial assistance, child nutrition cluster, HUD programs. There could be other. For example, on the child nutrition cluster, I know that there were several waivers issued that allowed meals to be served to kids outside traditional times. So those of you with children, think of your own personal situations. Schools might be fully virtual, so following the compliance requirements regarding meals is not really possible at this point in time. So there's various waivers out there just to be aware of. So COVID-19 funding, these were the 4 largest new programs. The Paycheck Protection Program, which I'm sure we're all well aware of. There was more than $600 billion issued for it through the SBA to both for-profits and nonprofits. The item of note here is that it is not subject to a single audit, so it does not have to go on your CFA. The second biggest program was going to be your provider relief funds at $175 billion issued by the HHS. These funds were generally being provided to hospitals and other healthcare providers. This is subject to a single audit requirement, so it is going to go on your CFA should you receive that money. Same thing with the Coronavirus Relief Fund and the Education Stabilization Fund. The Coronavirus Relief Fund, these funds were being provided directly to states and larger local governments. Many of these states and governments have passed down these funds to non-federal entities. So this program could impact you as a subrecipient or a granting agency. And then the Educational Stabilization Fund, these funds were provided to states, schools, and institutions of higher education. So our poll question number 4 is going to be, did your organization receive CARES Act fund besides a PPP loan? Yes, no, or unsure?
Just a few more seconds.
All right, so the results, 28% said yes, 63% said no, and then 9% were unsure here. All right, so what does this mean for you and us as auditors? The CARES Act funding is going to create more single audits than in previous years. So as mentioned before, those states that received coronavirus relief funds from the government have been passing it down to smaller entities such as nonprofits. And those additional funds may put you over that $750,000 mark. So just take note of that as you are getting towards year end. And if you're thinking that you might be approaching that threshold, it'd be good to reach out to your auditor sooner than later, because having a single audit versus just a regular, yellow book audit does change things rather significantly. So what does this mean to your financial statements? It's going to require separate identification of those awards. So this includes both new and existing programs. There's going to be a separate line on your CFA that is going to have COVID-19 as a prefix to the program name. This is also going to be presented separately on your data collection form for the single audit. And then below this is a little example of what it's going to look like on your CFA. So you can see in the yellow highlight is the COVID-19 prefix to the TANF program, and then the regular TANF funding, and then a program total. And then our last polling question for today is going to be, do you think that your organization is going to be required to undergo a single audit this year for the first time due to receiving additional CARES Act funding? So yes, no, unsure, or we already undergo a single audit, so it doesn't really matter. All right, so the results of the poll. Looks like one person said, yes, we're going to need a single audit this year due to the CARES Act funding. Half of you said no, 20% were unsure, and then 30% said we already undergo a single audit. As you can see kind of from the presentation so far, there's not a lot of new stuff as far as accounting standards that are going to be applicable for 2020 here, other than kind of your COVID-19 impact that has been discussed throughout the presentation thus far, which is kind of good because it's been, as mentioned before, kind of an overload of major standards that we've been adopting and implementing over the last couple of years. So on the next few slides here, we're just going to kind of go through a not-for-profit industry update. So kind of the state of the not-for-profit not-for-profit industry. NFPs play a large role in the world economy and is the third largest workforce in the United States. Currently, there are more than 1.6 million not-for-profits registered with the IRS and employ more than 11 million employees, which is 10% of the US workforce. Now I only have numbers from 2018 here, but contributions to nonprofits exceeded 427 billion. Record-breaking giving by foundations. Corporate giving also grew. Maybe an interesting one here is that contributions to donor-advised funds grew to 37 billion, an all-time high, and 86% increase over the past 5 years. This is kind of represents what seems to be maybe a shift in kind of donor thinking. They want to see how their donations are being used rather than just, writing a check and giving it to an organization as unrestricted money. So again, thinking of the current economy, what considerations are affecting the industry and your organization? COVID-19 and the CARES Act. Within that, there were the various loan programs and coronavirus relief funds. There is employee retention credit. Should you be eligible for it? There was the payroll tax deferral program. Interest rates have been declining over the last year. Availability of credit seems to have tightened some. Consumer confidence. Charitable contributions. I've seen this go both ways. So some organizations I've seen more donations come in than in previous years, but then for other organizations I've seen less. I suspect it's fully dependent on what that specific organization's mission is or what their program is. Real estate values and, kind of thinking about, your own organization. Are you working remotely? Is there going to be a decline there because businesses and organizations aren't going to need as much space as they had before? It'll be interesting to see what happens with that. And then kind of overall labor market conditions with considering the layoffs and furloughs that have been going on this year. And this is kind of just a copy paste from the S&P mid-year outlook. This is specifically related to higher education, but I think there can be it can be kind of indicative of overall concerns and outlook for the not-for-profit industry. So the S&P had a negative outlook and, in quotes here, a fall like any other we have seen before. So impacts from the current recession will vary by state, bringing reductions in state funding. So, think about your uncertainty in state budgets for upcoming grants. Maybe there's going to be a decline there, and what are you going to do to kind of fill that gap, should there be one? Auxiliary revenue may suffer. So when I hear that, I think of, those organizations that hold conferences or other educational programs, maybe a summer program that are kind of those incidental revenues. They're not your main revenue source, but they're offshoots. Have there been declines there due to COVID? And then, expense cuts are likely. I think we've kind of all seen that. From the IRS's standpoint here, in 2019, they repealed the parking tax. That was a very contentious topic in the nonprofit sector. So organizations that had previously filed 990Ts and paid their tax, you can file a 990T amended form to claim your refund. And you have up to 3 years from the time of the original 990T filing, or 2 years from the time the tax was paid, whichever is later. So if you have previously paid your tax and not filed an amended 990T, look into doing that sooner than later so you can get your money back. And that is also applicable for those estimates. Let's say you paid your tax and then had to pay estimates the following year. That also includes those as well. And then finally, we have just some considerations for those organizations that are going to undergo an audit here, within the next few months. We at Wegner have kind of transitioned to a lot of remote audits. And so what does that do for access to your books and records? From our standpoint, we've been pretty prepared for it as we service clients in the remote environment. But, for some clients, them working remotely has been a challenge, and limitations on their systems and access. So just kind of think about what impacts it might have should your audit be a remote one this year. Nobody likes to talk about this, but are there any going concern issues that need to be discussed and plans that might need to be disclosed? Collectability of those outstanding pledges. In years past, it's probably, we're expecting collection, but this year we might need to take a little closer look at it. And then inventory observations. I've done a couple remote inventory observations. I will say they've been challenging. But what are you going to need to do? What technology are you going to need to satisfy those observation requirements? For my personal example, I had a Zoom meeting and with a couple of employees where one walked around with the phone or computer or whatever they were using, and then another employee counted while I watched. It's the environments just created new challenges for everybody. And then finally, internal controls and segregation of duties. If you're working remotely, what's different? How are those checks getting cut? How are invoices being reviewed? The process is probably a little different, and we're going to want to make sure that there aren't any gaps in those segregation of duties. So just, again, some things to think about as we head into kind of the audit season here. One thing I will say is that increased communication between your auditor and the clients has been one of the key things to making this go smoother. That is all I had for the presentation. Emily, are there some questions?
We did have a couple questions just going backwards. This one's about the CARES Act. If your organization receives CARES Act funding subject to a single audit, do we only report the amount of the funding that we have spent on the CFA?
I'll have to get back to that person. I don't remember what the specific rules were. I believe it's the amount you've spent, but I'm not 100% certain on that one.
Okay. We know it's a lot of information to know right off the top of your head. This one was referring back to the PPP loan, actually. So they said the rules kept changing regarding the PPP loan, which I think everybody feels. The funds have all been spent. In hindsight, they should have been using the government grant model, but they have not been making the entries as expenses occurred. Is there any issue with entering one entry for the total since all was spent in the same fiscal year?
No, there's no issue there. Especially since it was spent all in the fiscal year. If you think about your year-end financial statements, it's the same regardless of model. It's going to show up as a forgiveness, and then just we can explain it in the footnote. Additionally, the FASB or the AICPA allowed you to essentially pick which model you used. So using the debt model is perfectly acceptable, regardless of what your intention was. It didn't matter.
Perfect. Is it worth the time to update finance procedures manual for remote work or wait until quarantine to let up?
Well, that's a tough question because nobody knows when this is going to end. I will say that if you do have an audit, your auditor is going to want to know what has changed. So from that standpoint, you could be proactive in doing that, but it's probably an organizational preference. And also, I've heard or read numerous articles where companies have gone remote due to COVID, and then things have been working well, so they've almost said you can work remotely going forward even when there isn't COVID. So from that standpoint, I think it depends on what your organization is going to do from a procedural or process standpoint in the future also.
Perfect. There are a couple other questions that are more specific, so we'll follow up after this presentation via email. Tim's contact information is on this slide, so feel free to ask him any questions. And you will be receiving these slides along with the recording from today to make sure you have all of this information as well. Tim, do you have any last minute comments or anything?
Nothing specific other than take care, everybody, and thanks for joining.
Wonderful. Thank you so much for your time and all of your expertise today, Tim. And thank you all for joining us. We hope you have a wonderful rest of your day.